All right, today we're going to talk about a really powerful financial strategy called Be Your Own Banker. It's a fascinating concept, and it all boils down to one thing, giving you way more control over your own money. So let's break down exactly what that means. You know that feeling, right? Dealing with loan applications, credit checks, high-interest debt, it can be frustrating. Well, this entire strategy was basically born from that exact frustration, and it offers a pretty interesting alternative.
Okay, so the official name for this approach is the infinite banking concept. Yeah, I know, it sounds a little grand, but trust me, the actual idea behind it is pretty straightforward.
At its heart, what we're really talking about is building your own private pool of capital. So instead of going to a traditional bank, you use a specially designed life insurance policy, one that's built to maximize cash value to create a personal financing system that you own and you control, all inside a tax-advantaged environment. So that's the what. Now for the how. How does this actually work in the real world? Well, the mechanics of building and then using your own private bank follow a pretty simple repeating cycle.
It really just comes down to 4 steps. First, you consistently fund the policy. Second, a piece of that money builds up as tax-deferred cash value. Think of it like equity. Third, when you need cash, you take a loan from the insurance company, using your cash value as the collateral. And fourth, and this is key, you repay that loan on your own schedule. That's it. This rhythm of building, borrowing, and repaying is what powers the whole thing.
Okay, listen up, because this is probably the most powerful and most misunderstood part of the whole concept. When you take out a policy loan, you are not withdrawing your money, you're leveraging it. The insurance company gives you a loan, and your cash value just sits there as collateral. And what that means is your entire cash value can continue to grow and compound, even while you have a loan out. It's like your money is doing 2 jobs at once. It's a huge distinction. So when you put all of this together, what's the big payoff? Well, it all comes down to that one single word, control. Let's look at the specific advantages you get when you step into the role of your own banker. Just look at the side-by-side comparison here. It's night and day. With a policy loan, approval is guaranteed because it's based on your cash value. There's no credit check, no underwriting, no third party you have to convince, and it's a private transaction. Compare that to a bank loan with all the paperwork, the credit dings, and the rigid payment schedules. The appeal is pretty obvious. It's less friction and a whole lot more freedom.
So let's just recap the biggest benefits. You get tax-advantaged growth on your cash value. You have access to liquid money without jumping through all the traditional bank hoops. Your policy's growth engine can keep on humming even when you borrow against it. You set the repayment schedule, and on top of all that, you still have a permanent death benefit in place for your family. It's a tool that does a lot of things at once. All right, now for a really important reality check. As powerful as this all sounds, this is absolutely, positively not a one-size-fits-all solution. So let's get real about who this is actually designed for and who it isn't. This strategy really thrives with 2 things, stable cash flow and a long-term mindset. It's fantastic for business owners who need access to capital without dealing with banks. It's great for high-income earners, disciplined savers, really anyone who values having ultimate control and flexibility over their own financing. This is a marathon, not a sprint. And on the flip side, who should probably stay away? Well, it's a terrible fit if you need a short-term quick fix, or if paying the premiums would put a strain on your budget. It's also not for people who are chasing the absolute highest stock market returns. This strategy is about stability and control, not necessarily aggressive growth. It just won't work if you're not committed to funding it for the long haul. So, to make this work, you have to do more than just own the bank. You have to think and act like a responsible banker. So, what are the rules of the road here? The rules are simple, but they're non-negotiable. First, don't overborrow. Use these loans for intentional, productive purposes. This is not a personal ATM. Second, you have to understand the specific loan mechanics of your own policy. Third, be patient. Let a strong cash value base build up before you start really leaning on it. And finally, see this as one tool in a larger financial plan, not a magic bullet that solves everything. Your discipline is what makes this strategy succeed or fail. And that really brings us full circle, doesn't it? This isn't just about a financial product. It's a fundamental shift in your mindset about money. So I'll just leave you with this question to think about. What would having more direct control over your own capital truly mean for your financial future, for your family, for your business? It's something to consider. Thanks for tuning in.